Okay, so let's look at the production cost and trading statement. As I'm saying in the exam, this is your main question. So they give us certain information. So this is the information. They give us balances for raw materials, inventory, work in process, and finished goods at the beginning of our financial year. Then they give us the transaction totals for the entire year, for the year ended 31 March. And then they give us our balances at the end of the period. And then what they say is please go and prepare the production cost statement as well as the trading statement and the notes to the financial statements of the company for the year ended. Okay. Now, what I said to you, we are when we look at the production cost statement, we are looking at those typical production costs that we looked at before, namely our direct cost and our factory overhead cost. That's really what we are looking for. So when we look at direct cost, we always talk about two components there: direct labor cost and the direct material cost. Now, in this question, it says that we must prepare the notes. Now, the notes is nothing else but the calculation that we do in order to get to the answer there. So when you start, obviously, you will not have an answer there yet. Okay, so this is basically, I'm just going to white them all out so that you can understand it. Um, wrong button. So this is really what you're starting with. So what do you need to know about your production cost statement is its makeup, its structure. How does it look? It has direct cost that splits direct material and direct labor cost. Then you have your factory overhead cost. Then you are going to get your total manufacturing cost. And then you are going to add your opening work in process balance, and you're going to subtract your closing. Because if you have your open, you have your closing, and you kind of knew what happened during the year. Well, if you know what happened during the year, then you will be able to calculate your cost of production of the finished goods. Okay. When it comes to your trading statement, let's quickly white that out as well. The trading statement is simply your gross profit. So it is your sales minus your cost of finished goods that will give you your gross profit. And that calculation of the cost of the finished goods sold, that is your note 4. Now let's have a look here at how did I calculate each of these individually. So once again, I'm just quickly going to hide these answers for you. Then you'll see how I got to that. Okay, so for the first one, the first thing we want to look at is our direct materials cost. Now, what I'm saying to you is what we are doing, we are taking our trusted highlighter and we have the word direct materials there. And then we go into the information given and we have a look for direct or raw materials. Now, please, they're just trying to confuse you here. They use direct materials. When in the question, they talk about raw materials. Direct materials and raw materials are exactly the same. Okay, so you will always start with your opening inventory. Okay. If it was a T account, it would have been what you brought down from the previous year. So your raw materials inventory from the beginning of the year is the first thing that you put in there. Okay, so it's not a secret, it was given. Okay, then we must add our credit purchases of raw material, because the only times where I see the word raw material is in these 4 instances, and that is why I took my trusted highlighter and I made them yellow, and then the answer, I'm keeping them yellow as well. So I have my opening inventory, my credit purchases of raw materials is also given. It is 310,881.92. So I can put that in there. Then the freight charges on the raw material is also given. Now, like I said to you, sometimes they can even give you a third component here that would be customs. But in this case, they've given us two components of the cost that contributes to our direct material, and we just simply take both of them from the table. Okay. Then what we do is we add these to get to a first subtotal. And then we get 423,719. Then we go and we look and we see, okay, but our closing inventory was also given as 45,000. And so now I can go and I can calculate my direct material cost by simply subtracting the 45 from the 423, and I get 378,118. Now that's the first amount that I go and I put that amount into my production cost statement. Then I go and look at the second component, which is direct labor cost. Now, when it comes to direct labor cost, I chose green. And the direct labor cost is actually in this question very nicely put out for us. It is specifically given in the under direct labor as those four components. So nothing difficult here. We simply go and we add the information that directs to direct labor as it is given to us. So it's given. We say that's fantastic. And we add it. Okay. And then once we have, sorry about that, once we have our direct labor cost, we can take that direct labor cost and we put that into our production cost statement. Now, the next thing we have to look at is our factory overhead costs. Okay, that will be note 3. So what did I do there? I said, okay, I'm going to use purple. Okay, so purple for that. So now we are looking at certain things here. We're looking at our indirect material, our indirect labor. There we had our direct labor. Now we look at our indirect labor and material, and then the electricity, telephone, insurance, rent, and depreciation, but only those parts of these monthly expenses that is actually contributed to the factory. The rest is admin cost. It's got nothing to do with our production cost statement. So we go and we say we look for indirect material. Okay, and now we have a little bit of a problem because here we see that we bought indirect material on credit during the year, and here we see that we issued some of that to the store and some we didn't issue. Now, okay, the confusing part in this particular question is they never gave us an indirect material balance at the beginning of the year. That is because at the beginning of the financial year, we had used up all our indirect material. So basically what we have is only what we bought and what is left. But they do not tell us what is left. They tell us what was issued to the factory. Okay, so if you take what was purchased during the year and you subtract what was issued to the factory, you will see what we have in store, even though it's not given. So they actually made it easier for us by telling us that these are the consumables that was issued to the store. If they didn't give you that, but they only gave you a closing balance here, then you would have said, okay, let me see, that was what I purchased minus my closing balance, and I would have known what I used. But now, in this case, it's simple. They actually tell us exactly what was used, and it's that part that was issued to the factory. So basically, you are not interested in the direct material, in the indirect material that was purchased on credit. You are only interested in what you used. Okay, indirect labor is given. So we can simply fill that in as well. Electricity, telephone, insurance, and rent as it contributes to the factory is given, so we can simply add all of those as well. Let's add, okay, and let's add. Okay. And then we get this other thing that we must also consider, and that is our depreciation. The depreciation on the factory machine, it is given, so we put that in as well. Now, like I explained to you before, the good practice is actually to have some kind of fund account. And so you will take this money from your normal business account and actually pay it into the fund account, so that when your machine comes at the end of its life, you will have both the money that you get from selling the machine as well as your accumulated depreciation paid into a separate account, so that you can go and buy a new machine, or at least give a very healthy deposit on the new machine. Okay. Now, of course, if you don't physically put the money somewhere, then you're still going to just show that depreciation, and then your asset value will just decrease, but then you're going to get more for it than what it's worth. It's something else. That is really part of financial statements. We're not going to look at that now. The only thing you have to worry about is that you were given that. Okay. With everything given, you can simply go and add it, and then put it into your production cost statement. Okay. Then you now can just simply add those, and you now have your total manufacturing cost for the year. To that, we must now add our opening work in process that was given as 14,872. Not a problem. And we can subtract our closing work in process that was also given as 192,000 and some cents. Okay. And then by adding the opening balance and subtracting the closing balance, we can see exactly what was the cost of production of finished goods. If I put it in the right little table block. Right cell, I correct. Okay. And so now I can see that the cost of production of finished goods was 1,520. Okay. Now we can start by doing, now we can do our trading statement. Okay. Now the sales is given. Okay. Because where is that? Sales of finished products. It is given. So we can just put in that amount that's a little over 5 million. And now we have to calculate the cost of our finished goods. And the cost of our finished goods, that is our note 4. Okay. And that is quite simple. We take the opening balance of our finished goods, which is 75,000. To that, we add the cost of finished goods, which is the answer of what we got in our production statement, that 1.5. So that is the amount that we add there. And then we subtract what we were given again here as raw materials on hand. Not raw materials, sorry, work in process on hand. So we put that in. Okay, so by starting with our opening, adding the cost of the finished goods sold, and subtracting the closing stock of finished goods, we can see then what our cost of finished goods sold is in total. Okay, so now that we have that amount, we take it and we simply put it in our trading statement, and then the gross profit is is simply the difference between those two amounts.